How's everyone doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berkowitz. So today we're going to be taking a look at 4 regulatory challenges that are currently facing community banks, as it were. So I came across a really good article in Independent Banker magazine, which I'm going to bring up to show all you guys now. And this is titled 4 Regulatory Challenges Community Banks Face Today. The regulatory environment for banks feels like it's being turned upside down, but the fundamentals of compliance and risk management remain the same. We look at a few of the challenges community banks face today and hear from ICBA experts on what's next. Now, before we get into these, I just want to break down the 4 things for you. So challenge number 1, navigate an uncertain regulatory environment. And then we're going to scroll down here. Challenge number 2, address supervisory focus on issue remediation. Let's see here. Challenge number 3, establish financial resilience. And then challenge number 4, monitor non-financial risks and internal controls. So again, I think some really good ones here. And now let's go back up, and we're going to go back to number 1 here. So the banking industry faces a dynamic regulatory and compliance environment that's being shaped by several different factors, such as the presidential administration's agenda, changes in control of Congress, and new leaders of the regulatory bodies. All of this has caused a shift in supervisory priorities among bank regulators, including deregulatory efforts and the potential rollback or even overturning of previous administration's regulatory efforts. Even in a more permissive regulatory environment, it's important to remember the changes to banking supervision and regulations occur slowly. Community banks should remain focused on addressing their outstanding supervisory issues, prioritizing governance, risk management, compliance and controls, and demonstrating sustainable remediation. Failure to do so could lead to extended time in the regulatory penalty box. In its 2025 Banking Regulatory Overlook, Deloitte took a deep dive into the evolving regulatory and compliance landscape that banks face this year. During transitions between administrations, interagency regulatory actions such as rulemaking and supervisory guidance generally slow down, perhaps rising modestly later in the year. On the supervisory side, the report notes permanent staff generally aren't affected, so banks' primary supervisory contacts tend to remain constant. Deloitte identified 4 key regulatory and compliance challenges facing community banks this year. So we're going to read on to take a look at these different ones. Ann Balser from the ICBA, she basically commented saying, the challenge of financial resilience is nothing new. Community banks have weathered numerous storms in the past, from banking and financial crises to inflation and times of market uncertainty. So good chat. Now, I just want to say before we dive into this, the regulatory ping pong, as it were. So if we go, I would say going back to the 07, 08, 09 financial crisis, obviously that crisis exploded at a time when you had a change of administrations. You had the 8-year term of Republican George Bush coming to an end, followed by the beginning of an 8-year run for Barack Obama, a Democratic president. And I think starting with that financial crisis and starting with Obama coming into office, obviously we had the Dodd-Frank Act. We had a number of major changes in the banking regulatory landscape. Bank regulators, treated banks very differently. I feel, personally, for a number of years under the Obama regime, everything felt like a gotcha. Like all of the regulations that were being written at that time were very vague, and we're vague on purpose. And I'm just going to give you an idea as to how did it feel. So it felt like this. You would come, Dodd-Frank comes out, and they'd say, okay, you have to have a red table in your. It says here you have to have a red table in your bank. Okay, I bought a red table and I put it over here in the lobby. Okay, and then a year later, the regulator comes back. It goes, why is that red table over there? That red table's not supposed to be over there. That's supposed to be up on the 3rd floor. And you're like looking at the bank regulation. Well, all it says in here is that I'm supposed to have a red table, in the bill. It doesn't say where I'm supposed to be. Well, it doesn't matter. I'm telling you where it's supposed to be. So it's on the 3rd floor. You're fine. That's it. You're fine. You're done. And that was how that was kind of the general sentiment. Like everything was it felt like everything was set up as kind of a gotcha. Gotcha. We knew you were dirty. We got you now. So it created a lot. I think it created a lot of unease in a lot of banks across the country. A lot of good, strong, fundamental banks that were doing absolutely nothing wrong, just running their business day in and day out, and we're just getting beat up constantly. And then we get into these like even more volatile swings here. Then Trump administration comes in 2017. And you have kind of a whole, you're much going back to much more of a deregulate, cut the red tape, let's get out of the way. We had overregulation during Obama, and then things started to go back to a positive place in the Trump administration. And then in the Biden administration, you swing right back to another, just completely opposite end of the stream. And we're still dealing with a lot of stuff from the Obama administration. There's a lot of stuff hanging out there, open banking, beneficial ownership information, 1071 rule. I mean, there's CRA. There's a whole bunch of stuff out there that's still being worked through. But I think the article hits this head on in the sense that this stuff should move a little bit more slowly because again, banking is supposed to be, for the most part, I think, a very stable, kind of boring kind of business in a way. It's like, okay, you take deposits in, you lend money out. Again, it's a good business, but I don't think it's meant to be this kind of crazy, hair on fire type business that the regulators have to be all over you every 5 seconds. Again, so I think they're correct in that assessment that this stuff should be a little bit more slower moving. The pace of change should be slower moving, but that's not really what we've seen. I mean, like I said, over the last 8 years, I mean, it's just felt like a ping pong ball. You're just going boom, boom, back and forth, back and forth, back and forth. And that's not good. That's not good. I mean, you certainly don't want things to move too slow, but you don't want things to move so fast, and you don't want the pendulum to be just rapidly swinging from one side to the next. That's not good for the banking business. But anyway, so like I said, I hope that just gives people maybe a little bit more flavor. So anyways, let's go in here. So challenge number 1, navigate an uncertain regulatory environment. So according to the Deloitte report, banks should prepare for an even more complex and uncertain regulatory future. This could require heightened vigilance and adaptability by community banks for strategic planning and compliance. Given the considerable difference in direction, states the report, banks should closely monitor regulatory developments and be prepared to invest in their regulatory change management capabilities. Administration changes are always challenging for banks because new administrations tinker and make adjustments to the regulatory landscape, says Jenna Burke, Executive Vice President and General Counsel for Government Relations and Public Policy at ICBA. In the current environment, there's a big emphasis on deregulation. So there is some optimism that there will be more regulatory certainty and straightforward reforms moving forward. Yeah, I would absolutely agree with that. I think a lot of the regulatory uncertainty again falls into all of these things, like what's going to happen with open banking, what's going to happen with 1071. They're going to revise and repropose a number of these rules. So we're going to get this stuff in some way, shape, or form. But the bigger question is, what's it going to look like? And so I think you have to be prepared for that. However, the administration on the whole, I don't think that there's like a whole lot of surprises coming out. Again, I mean, I know they're pushing the crypto bit very hard. But other than that, it's basically, hey, let's deregulate and get out of people's way. Let's not do this. So let's jump down. Challenge number 2, address supervisory focus on issue remediation. So despite the new administration, banks will still be expected to close outstanding issues and enforcement actions and improve or sustain risk management and controls. New administration does not automatically close existing supervisory findings or enforcement actions, states the Deloitte report. There are internal procedures and protocols that must be followed. Thomas says that examiners are increasingly focused on identifying issues that pose the most significant risks to a bank's safety and soundness rather than smaller technical issues that have minimal effects. This will allow community banks to spend less time focusing on immaterial issues that aren't relevant to them, which is a huge benefit. Issue remediation is usually the first thing examiners review during subsequent examinations, regardless of the materiality materiality of the findings. Balser notes, it could be a significant finding that's determined to be a deficiency or something pretty benign, but that's where the next exam usually picks up. So yeah, again, good points there. And then let's roll down to number, oh, wait, I think we skipped, where did we skip? All right, so number 3, establish financial resilience. So according to the Deloitte report, supervisors are closely examining banks' financial vulnerabilities and ability to respond appropriately to changing financial conditions. The new administration is likely to focus on balancing core financial resilience within the banking system and promoting financial market growth. It states, new banking agency leadership and upcoming changes to financial standards may have significant implications for banks' cost of capital and liquidity. Regulators are taking an especially close look at liquidity since previous liquidity stress events have caught their attention. Commentary has focused on the need to reevaluate the current liquidity risk frameworks. From our experience, the report says supervisors are concentrating on banks' intraday liquidity risk capabilities, the operational readiness of banks' contingency funding plans, and the requisite controls and risk management practices of each. So I have a couple of things on that real quick. So number 1, leave the Federal Home Loan banks alone. Banks have lines of credits with the Federal Home Loan Bank. If it ain't broke, don't fix it. Leave. So number 1, leave them alone. Number 2, I do think that there is this massive issue in terms of unrealized losses in banks' bond portfolios. That is still a major issue in the banks. In the banking industry, there are still a lot of banks out there that have these holes in their balance sheet. And that is something that I think and this has been lingering for a couple of years now. So it's not like this just happened yesterday. It's been a while. And I do think that the time may be coming when regulators need to put a little bit more pressure on certain banks to basically say, hey, you know what? We know you don't want to take this loss, but you got to do it because you got to get your balance sheet fixed. You got to get this repositioned. Because if something does hit, you're going to be in serious problems, like just like Silicon Valley Bank. And then finally, challenge number 4, monitor non-financial risks and internal controls. So the Deloitte report identifies several key non-financial risks that regulators will continue to focus on and where the banking industry at large may still need improvement. These include operational resilience and cybersecurity, evolving financial crime and fraud typologies, and third-party relationships. Additionally, banks should consider the emerging development of artificial intelligence and how it may fit within the institution's risk management framework, states the report. Yeah, I agree with all those things. Many community banks maintain a patchwork of legacy systems. At the same time, cyber threats continue to evolve and become more sophisticated. With increased complexity, there's a greater need to develop, maintain, and document adequate internal controls to guard against these risks, says Thomas. Risks to community banks may also be exacerbated by outsourcing to third-party service providers that help deliver and monitor core operations. Regulators are focusing more on the connection points between banks and service providers and emphasizing the importance of third-party risk management processes. Community banks need to stay on top of their vendors and be aware of any changes or developments that could impact them, says Burke. Additionally, community banks need to remain vigilant amid heightened cybersecurity and check fraud risk, which we often hear are among bankers' top concerns. ICBA offers helpful resources to members, including a cyber and data security resource center and check fraud resource guide. Yes, absolutely. So I agree with all of those sentiments. So again, I really like this article just because I thought it did a good job of just laying out, where banks are at today in terms of their regulatory concerns. I hope this gives people, just again, some good information coming in here. If you're not real familiar with the type of regulatory issues that community banks are facing, hopefully this gives you a little bit more insight. But if you are, if you work for a community bank out there and you're kind of well aware of some of these issues, hopefully it just, maybe relays a little bit of fear that, you're not the only one dealing with this stuff. Everybody across the industry is dealing with these issues, and we continue to go from there. But with that being said, I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank everyone for listening. Have a great day out there, and I will see everyone again real soon. Thanks a lot.